Welcome back to the Deep Dive. Today is Tuesday, February 3rd, 2026, and you are tuned into a special edition of the show we call Griffonomics.
It's good to be back.
So if you're a regular listener, you know the drill. We take a pile of earnings reports, transcripts, all that dense stuff, and we really try to distill it down into something, actionable.
And today we have a case study that, honestly, it feels a little bit like a glitch in the matrix.
It really does. Usually when we talk about financial infrastructure, we're talking about the invisible plumbing of Wall Street. It's the boring stuff. But our subject today, Broadridge Financial Solutions, has somehow managed to turn that boring plumbing into, I think, one of the wildest crypto stories of the year.
It's a fascinating pivot. Broadridge is a company that pretty much everyone in finance knows, usually because they're the ones clogging up your mailbox.
Right.
They're the behemoth behind proxy processing.
Yeah.
If you own a stock and you get that voting card,
Yeah.
it came from Broadridge.
The postman of the stock market. But looking at this Q2 2026 earnings report we just tore apart, they are not just mailing paper anymore.
Not at all.
They seem to be undergoing this radical metamorphosis into a blockchain powerhouse. But I have to be honest, looking at the numbers, some of this just looks a little strange.
Strange is a polite way to put it. There are some financial anomalies in here that we really need to dissect.
Exactly. So here's our mission. We're going to do a granular investigative report on Broadridge's Q2 fiscal 2026 earnings. We need to figure out how this legacy company is pivoting to tokenization, and we have to solve this mystery involving something called Canton Coins.
And a $188 million accounting distortion.
That's the one.
And that's the headline right there. If you just glanced at the news, you'd see Broadridge's earnings are up 100%, doubled. But if you stop reading there, you are missing the massive, slightly distorting reality hiding in the balance sheet.
Okay, let's unpack this. But before we get to the crypto mystery, we have to establish the baseline. How does Broadridge actually make money today? Because they're not a startup.
No, not at all. They're very much an establishment player. I think the best way to think about their business model is as a toll booth.
A toll booth?
Yeah, Broadridge basically owns the roads that Wall Street drives on. They have two main engines. The biggest is Investor Communication Solutions, or ICS. That brings in about 72% of their total revenue.
And that's the proxy business, the mailing.
Mostly, yes.
Yeah.
Proxy processing, regulatory distribution. And the key here is just how stable it is. In this quarter, recurring revenue in that segment grew 9%.
Okay.
And regulatory revenue specifically jumped 18%. That was driven almost entirely by a 17% growth in equity positions.
So simply put, more people own stocks, so more documents need to be sent out, so Broadridge gets paid more tolls.
Precisely. The second engine is Global Technology and Operations, GTO. This is the back-end software, the stuff that powers the trade life cycle.
The really invisible plumbing.
The really invisible stuff. Wealth and investment management revenue in that segment rose 12%. And that was helped by their recent acquisition of SIS, that Canadian wealth tech firm.
Okay, the growth numbers are fine. They're solid. But the number that always jumps out at me with Broadridge is the retention rate. It's 98%.
It is staggering.
But let me play the skeptic here. Is that 98% retention because clients love them, or is it, a hostage situation?
It's a bit of both.
I mean, ripping out your back office infrastructure sounds like a nightmare. Are they good, or are they just impossible to fire?
Look, it's an incredibly sticky business model. Once a bank integrates Broadridge, the cost of switching is it's prohibitive. That creates a moat, a very, very wide moat. But, and this is where the pivot comes in, management knows that just mailing paper isn't a growth strategy for the next 20 years.
Which brings us to the strategic shift. The CEO, Timothy Goki, came out swinging on the earnings call. He wasn't talking about postage rates. He was talking about tokenization.
He said it's gaining steam across capital markets. And he has a very specific plan.
Which is?
By the end of this calendar year, 2026, Broadridge plans to integrate tokenized assets directly into their proxy capabilities.
Okay, break that down for me. What does that actually look like?
It means extending voting solutions right to your digital wallet. So imagine you hold tokenized equity in Apple or Tesla. Instead of getting a piece of mail or even an email, you vote your shares directly on the blockchain from your wallet.
And Broadridge facilitates that.
Broadridge is building the infrastructure to make that happen, yes.
Okay, that sounds efficient. But here's the existential question I always have with these corporate blockchain projects. The entire idea of crypto is disintermediation.
Right.
It's about peer-to-peer. If I can vote on the blockchain, why do I need Broadridge in the middle taking a cut? Isn't this tech literally designed to kill their entire business model?
That is the billion-dollar question. And Broadridge has a very specific answer. They call it the complexity defense.
The complexity defense.
Right.
Sounds like a legal strategy.
It basically is. Their argument is that tokenization doesn't make things simpler. It actually makes them messier.
How so?
Sure, you can move a token from wallet A to wallet B, but what about tax lots, corporate actions, stock splits, dividends, and maybe most importantly, what about privacy laws?
You're talking about the obonobo distinction?
Exactly. Objecting versus non-objecting beneficial owners. It is a regulatory nightmare to track who wants their identity revealed to the company and who doesn't. Smart contracts are clever, but, they aren't lawyers. They can't handle that kind of complex compliance logic on the fly.
So Broadridge's pitch is, the blockchain is the new database, but we're the adult supervision.
That's a perfect way to put it. They position themselves as the managed service layer. They handle all the dirty work of compliance so the banks don't have to.
And is the market buying it?
It seems so. They have over 600 funds covering $4 trillion in assets using their voting choice solutions already. They are successfully porting their monopolies from paper to digital.
All right, so the strategy makes sense on paper, but let's look at the execution, specifically this Canton network. This is where the numbers get, well, they get huge. They threw out a stat about their distributed ledger repo platform, DLR. They said it tokenized $384 billion per day in December 2025.
$9 trillion for the month.
That's an insane amount of money. But for everyone listening who doesn't live on a trading desk, can we pause? Why does tokenizing repo even matter?
This is crucial to understand. The repo market repurchase agreements. It's basically the pawn shop for the entire banking system.
Right.
Banks trade collateral, like treasuries, for cash overnight, just to manage their liquidity. It's the grease that keeps the whole financial engine running.
And traditionally that system is clunky.
It's incredibly inefficient. In the old world, settlement is T+1 or T+2. That means if I trade with you, the assets and cash don't actually move for a day or two. That creates what we call trapped capital. Your money is just stuck in the pipes.
And there's risk. A lot can happen in 24 hours.
Well, a ton. Broadridge's DLR platform allows for atomic settlement. The trade and the settlement happen at the exact same time on the blockchain. So that $384 billion isn't just a volume number. It represents hundreds of billions of dollars of liquidity being freed up instantly.
Okay, so that is a genuine value add. I get it. That explains why the banks are jumping on it. But this brings us back to the financial mystery, the Canton coin distortion.
Right. Time to put our forensic hats on.
The headline says earnings are up 100% to $284.6 million. But when you look at the breakdown, $188 million of that came from remeasuring digital assets, these Canton coins.
You're right.
This sounds dangerously close to the kind of mark-to-market accounting that, got companies in trouble in the past. Are they just booking profit on coins they haven't even sold? Is this real money?
It's not cash profit, no. But it is required by the rules. There's a new accounting standard, ASU number 2023-08, and it forces companies to mark their crypto holdings to fair market value every single quarter.
So because the value of Canton coins went up,
they had to report a massive paper gain. They had no choice.
So it's phantom income.
In a sense, yeah. If you strip out that 188 million crypto gain, the picture changes drastically. Their adjusted EPS, the non-GAAP number they want you to look at, it only grew 2% to $1.59.
Wow. That is a massive spread, 100% growth versus 2% growth.
It is. And the reason the core growth was so low is that their event-driven revenue, the high margin fees they get from proxy fights and special meetings, that actually dropped 27%.
So without the crypto pump on the balance sheet, this was actually a pretty mediocre quarter for the core business.
From an earnings perspective, yes. But, and here is the counterargument, look at the cash flow. Free cash flow hit $319 million for the first half of the fiscal year. That's up from just $56 million the year before.
Okay, that's significant. So the paper earnings are messy, but the actual cash register is ringing louder than ever.
Exactly. And that cash gives them the runway to keep playing with these digital assets, which leads us to the wildest part of this entire report, the Theramune transaction.
I read this 3 times, and I still need you to walk me through it. Broadridge gave 342 million Canton coins to a company called Theramune to create a digital asset treasury, and they booked a $53 million gain. What is actually happening here?
This is financial engineering at its absolute finest. So Broadridge earns these Canton Coins by acting as a super validator on the network. Think of it like a credit card processor earning transaction fees, but they get paid in tokens instead of dollars.
Okay, so they have a big pile of these
A
tokens.
huge pile. But tokens on a balance sheet are volatile. They want to monetize them. So they found a partner, Theramun, who wants to hold these assets. Broadridge contributed the coins in exchange for equity warrants and a position in the company.
So they turned utility tokens into corporate equity?
Effectively, yes. They crystallized that phantom value into a tangible asset, an investment in another company. That $53 million gain is them proving that these coins are not just monopoly money.
It's clever. I'll give them that. They're monetizing the infrastructure itself, but it feels risky. And speaking of risk, management gave a pretty direct warning about a coin cliff.
They did. This is the big risk you have to watch. They explicitly warned that validator rewards, those free coins they get for running the network, are going to moderate significantly in the second half of fiscal 2026.
Why? Is the network use dropping off?
No, it's a structural change. The network is changing its minting curve. It's kind of like how Bitcoin has halving events. As the network matures, the protocol issues fewer rewards to the validators. The free money spigot is being tightened.
So that $188 million paper gain we saw this quarter, that might be the high watermark.
Very likely.
Yeah.
We probably won't see another windfall quite like that again. And if you combine that with margin pressure in the core business,
Right, the margins fell.
adjusted operating income margin fell 110 basis points to 15.5%. And you can see why the adjusted EPS growth was only 2%.
And the margin drop was due to interest rates and revenue mix?
Mostly. Broadridge holds a lot of client cash, what's known as float. When interest rates dip, they earn less on it. Plus, they're shifting towards some lower margin distribution revenue. They're selling more, but it's not as profitable yet.
So let's zoom out. We have this legacy monopoly, 98% retention. We have a massive institutional scale blockchain pivot that's moving $9 trillion a month. But we also have confusing accounting, a coin cliff coming, and sluggish core growth. What's the verdict? Is this a buy or is it just too messy?
The street seems to be calling this a defensive growth core, which I think is about right. Despite all the noise, management actually raised their full-year adjusted EPS growth guidance to a range of 9 to 12%.
That's surprisingly confident given all the headwinds we just listed.
It is. They're basically telling investors, look, ignore the quarterly volatility of the crypto assets. Our core engine is accelerating. They're using the cash from the legacy toll booth
To fund the future. It's the classic cash cow funding the star strategy.
Exactly. It's a portfolio protector. If the crypto bet fails, well, they still own the plumbing of Wall Street. If the crypto bet succeeds, they own the new plumbing of Wall Street.
They're hedging their own disruption.
And they're doing it at a scale that no startup could ever dream of touching.
It's a compelling narrative. But before we wrap, I want to go back to that paradox you mentioned at the start, this idea of the centralized, decentralized giant.
That's the thought I really want to leave listeners with. We spent the last decade hearing about how blockchain would remove the middleman, right? The whole narrative was that code would replace corporations.
Code is law.
But Broadridge is proving the opposite. They are proving that if the middleman owns the nodes, and if that middleman understands the regulations better than anyone else, they don't get removed. They get stronger.
Because the banks don't want to deal with the code itself. They want to deal with Broadridge.
Exactly. In a world of decentralized finance, the most valuable player might just be the one centralized entity that knows how to connect all the dots for everyone else.
So the future isn't peer-to-peer. It's peer-to-Broadridge-to-peer.
At $384 billion a day, it certainly looks that way.
A sobering thought for the crypto purists, but a profitable one for Broadridge. Thanks for listening to this deep dive into Griffonomics. Keep looking beneath the surface, and we'll catch you on the next one.